Hello, good morning to all and happy Friday. I'm Kelvin here again. Welcome to today's Daily Dose of Market Insights. Happy Friday and good morning. Today will be the 7th of June 2024. So before we start our Daily Dose, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell or financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monitored Authority of Singapore. All right. So as usual, before we jump straight into the short-term technical intraday outlook on the broad-based cross assets, let's have a quick recap of what has taken shape yesterday in terms of economic data news flow, and as well as today's early Asia session before the start of our day dose as we speak today. So let's start with the economic data first. So yesterday, key economic data will be the release of this highly more or less well telegraphed, I'll put it with that, well guided first interest rate cut up from Eurozone. So yesterday, ECB cut rates as expected, but what caught market by surprise yesterday was there was actually an upgrade or kind of a revision upwards on their inflationary expectation going forward into the end of this year and 2025. So now let me pull up the latest so-called inflation trend projection out from Eurozone. Okay, give me a minute. Let me pull up the stuff. Yeah, this is the one. All right, let me expand my screen so that you guys could see. Okay, so this is the latest inflation projection for 2024 and 2025. So those bars that are in black are the projection released in the March meeting. So every 3 months they will release the new inflation projection in Eurozone. So yesterday, just in time for the 3 months after March will be in June. So the next release will be in September meeting. So what you could see over here is that this is the headline inflation, including food and energy, or the 3 years from this year, 2025-26, all has been revised upwards. That means previously they are looking at 2.3%, and right now the latest forecast by the end of this year it will tick up by 2 basis point high, 2 basis point higher to 2.5%, and going forward in 2025 it will slow down but to 2.2%, but above its prior forecast of 2%. And going forward into 2026, it will remain the same at 1.9%. And if you were to look at this particular metrics over here, which is much more important because it's excluding the much more volatile items, which is food and energy, similar a trend as well, where we start to see a push up in the 2024 year-end forecast to 2.6% by 2 basis points from 2.8% projected in the earlier meeting in March. And what's interesting over here is that only in 2026, it will actually slow down to 2%, which is the ECB desired inflation target. So what it means by this latest inflation forecast figure, the thinkings of ECB officials is actually veering towards the cautious side of the stance after yesterday's first interest rate cut since 2 years, okay, to bring down to 25 basis point for the main refinancing rate to 4.2%. Okay, so at the end of the day, after this first interest rate cut yesterday, going down the road, the forward guidance is rather unclear. That means, number one, there is no clear indication that ECB will be on a ultra dovish stance. That means once you cut interest rate, the next few meetings there will be a following cycle of persistent interest rate cut down the road. But ECB is not taking this path as being expressed by their latest inflationary forecast. So what it means that they, in their thinking, they do expect inflation expectation in Eurozone expect to be rather sticky at this point in time until 2 years later. That means only in 2026, then it will start to actually inch down towards their 2% desired inflation target. So what it means that ECB is also having this mandate or mantra, I would say, of keeping rates at this higher, rather a higher level or restrictive level for a longer period of time. That means, i.e., this is the current stance of the interest rate trajectory after yesterday's cut. So they bring it down to 4.25% from 4.5%. That's the main refinancing rate. So it could, after this first cut yesterday, it bring down, it could remain the same for the next 3 to 4 meetings down the line. Okay, so that actually also support the short-term intraday dollar weakness yesterday that we are actually expecting based on yesterday's daily dose short-term technical intraday outlook on the major dollar FX pairs for those who actually follow our daily dose of market side on a frequent basis. All right, because we know that as long as ECB, which is one of the key major central bank, remains less dovish as what the market is expecting, it supports the euro against the dollar. Eventually, it actually sees the US dollar strength putting on a cap on the top side. So if you look at the trend of the US dollar yesterday, let me share with you the dollar index. So the dollar index, after breaking down below the 200-day moving average, which is on this Monday, all right, sorry, on this Monday itself, it actually fails to actually break out, retested it on Wednesday, and yesterday it shaped that bearish candlestick reaction right off below the 200-day moving average and right below the previously broken up, which is at the 104.20 level. This level is dotted red line over here. So this was actually also being supported, like I mentioned earlier, that less dovish stance right now being adopted by ECB as inferred by their latest inflationary trend projection in Eurozone, okay, for 2024, 25, and 2026, as explained earlier. So this is the key data that took shape yesterday in terms of the news release. Now, early today's Asia session, there is actually another important release, which is Japan. So those who follow the Japanese economy, what we could see over here is, the Japan household spending, which is put in a way that is a proxy for retail spending or consumer spending in Japan, it actually rose better than expected. So if you look at the month-on-month basis, okay, not month-on-month, the year-on-year basis, once month-on-month is quite erratic. So on a year-on-year basis, the trend actually turns positive, all right? So previously it was negative 1.2% year-on-year, and it actually inched back up to 0.5%, slightly below expectation of 0.6. So let's look at the trend over here. Okay, notice that after a subsequent period of, okay, I'll put it 5 year, after being negative since almost a year ago, which is at March 2023, it seems to me that it starts to bottom up and the recovery pace has started to strengthen since the start of this year, and right now it moves up to the positive territory of 0.5%. So it seems to us that after that higher wage negotiation, as negotiated by the Japanese, we call it a union with the employers, has starts to take effect in terms of the spending habits of Japanese household. That means they're more confident in their spending. How does it translate to the market? That means, i.e., it will be definitely positive in terms of the risk on impact on the Japanese stock market, and as well as in BOJ, one of the key metrics about BOJ, quicken its pace of normalization. So BOJ right now is no longer looking to cut interest rate further back to negative again. So they are now looking for evidence on how they could actually normalize their ultra decade plus of dovish monetary policy back towards normalcy. That means, i.e., they're looking instead for evidence of the next interest rate hike. So given that this is one, consumer spending is one of the key metrics they're looking at, and it's actually right now supporting their ongoing continuing we call it aim of normalizing their past ultra accommodative monetary policy in Japan. So that also could actually increase the odds of other two things. They could actually further reduce their bond purchase, the JPY purchase, allowing market forces to dictate the direction of the JGBU, and potentially could actually shift forward the next interest rate hike, where there's actually, based on the overnight swap market, there's actually an increasing chance of the next rate hike to come in July rather than in September, which is in Q3 this year. So that could also keep the pace of the dollar strength against the Japanese yen in check. That means preventing further so-called steepening pace of dollar appreciation against the Japanese yen. So that's why the dollar yen yesterday remains stuck below its 20-day moving average at around the 156 figure level, which I covered in my short-term technical intraday outlook yesterday as well. So later I'll touch more about that. So now, as we are speaking, now it's already 11:13, so we should start to see the release of the China trade data. Okay, so China trade data actually came in better than expected on the external front. So from the external front, which has been external demand, which is being measured by the exports. So exports year on year came in better than expected, 7.6% year on year, above 1.5% that was seen in the previous month of April, and above expectation of 6%. But what disappointed over here is the imports. So imports came in way below expectation of 4.2%, also way below the previous month of April at 8.4% year on year. So only lackluster 1.8%. So what it means that over here is that there's still some signs of softness in internal demand, because based on the imports figure. All right, so it's rather a mixed data right now. So that will actually explain not so much of a movement in the China related stock market and the Hang Seng index as we are speaking. All right, so let's have a, okay, so that's about the key economic data released yesterday. So let me touch on some of the intermarket analysis. All right, so looking at forward the 10-year US Treasury yield again, that could actually impact the the FX market and the stock market. So we know that the dollar remains kind of weak. Okay, bearish reaction of the 200-day moving average, and what we could see this being also shown on the 10-year US Treasury yield as well, where price action actually also didn't actually surpass the previous bearish candlestick that broke down and retested the 200-day moving average on Wednesday. All right, so still holding below that 1.32% former key medium-term pivotal support now turns into a pullback resistance. And if you look at the 200-day moving average, so it will be like a zone over here. This level 4.36, so 4.36% and 4.32% will be this key resistance to watch forward in this coming 1 to 3 days. All right, and especially today, based on the upon the key release of another key risk data, which is the US non-farm payroll data that is out later today. Later I'll touch about the non-farm payroll data when we talk about the economic data releases for today. All right, so that's for now. So as long as this yield is being tracked below the 4.32%/4.36%, potentially we could still see further dollar weakness, at least in the short-term basis, short-term intraday basis, and that could also translate to supporting this ongoing short-term intraday bullish trend that is being seen on the major US stock indices, as well as the rest of the world that we covered. All right, so that also being said that if the US 10-year Treasury yields remain capped below this key resistance, dollar weak, that also will support gold price as well, XAU/USD, which actually continues to rally yesterday above its 20-day moving average. All right, so now with that covers much on the intermarket analysis. So let us now jump forward to actually discuss more about the short-term intraday outlook in terms of the technical analysis outlook for today. So let us start with the FX market first. So as you could see, before we jump into the individual dollar pair, has a quick look at the 5-day rolling performance of the US dollar against the major currency. So what you could see over here is a rather sideways movement in the based on this 5-day rolling performance of the US dollar against the other major currency. All right, so the one that is underperforming the dollar index right now is actually the yen, the kiwi, and as well as the Swiss. All right, that means the dollar is kind of weak against the kiwi, against the yen, and against the Swiss franc at this moment in time. Now, straight away, let's jump to the short-term technical outlook, starting on the euro dollar first. So what we could see over here, the euro dollar based on yesterday's lesser than expected dovish implied expectation based on their higher inflationary forecast in Eurozone supports this ongoing short-term intraday bullish bias on the euro dollar that we have since the start of this week. All right, so I could see prices managed to hold support right at the lower boundary in the last two sessions yesterday, including yesterday. It came down, tested, and shaped a bounce. So for sure, right, this level here at this 1.060 level, 1.0860 level will be my short-term pivotal support level. Okay, so before we go further, let me expand my screen so that you guys could see. All right, yeah, that's better. So for today, we will have a Titan key short-term pivotal support at this 1.860 level to maintain our short-term intraday bullish bias on the euro dollar. Next, the near-term resistance zone to watch will be at the 1.025/1.0940. A breakout above it sees 1.0950 next, which is so confluence the upper limit of this minor ascending channel that I drew from the low of 31st of May. Only an hourly close below 1.0860, which is now also confluencing with the upward sloping 20-day moving average, will negate this short-term intraday bullish bias and see a choppy minor corrective decline to retest last Friday minor swing low at 1.0810. A breakdown below it exposes the 200-day moving average that is also confluencing with the minor swing low area of 30th of May, and as well as the former minor swing high of 3rd of May, all indicating to a similar level at 1.0790. Sterling dollar. So the sterling dollar traded sideways yesterday, also pretty much holding the fort in line of this broad-based dollar weakness as well, being supported by that less dovish stance implied by the ECB latest forecast on their inflationary trend expectation. So it kind of trades sideways over here, holding above our first support level, which we highlighted yesterday at 1.2760. So because that level is slightly above the 20-day moving average, which is so confluencing at the 127 figure, that managed to shape a much more vicious V-shaped intraday bounce on Monday. So I'll be still using 1.27 figure level because it confluences with more positive elements as my key short-term pivotal support for today. So no change, 127 figure level, short-term pivotal support to maintain this ongoing short-term intraday bullish bias on the sterling dollar. First resistance to watch near term 12860/129 figure. A break above this level exposes 1.2940 next. Only an hourly close below 127 figure level, a breakdown below it, hourly close, invalidate today's intraday bullish bias to kickstart another round of minor corrective decline on the sterling dollar, exposing the next near-term support level at 12670/12640. Below it sees the 50-day moving average coming to act as a support at the 1.26 figure level. All right, so moving forward, the Asia Pacific currency, starting with the dollar yen over here. So where's the dollar yen? Let me have a quick. Yep, so this is the dollar yen. Okay, let me adjust my thing. Yeah, dollar yen. So this dollar yen, given that very much more better than expected household spending, so what we could see over here is that it failed to actually break above the 15660 short-term pivotal support that we have since on Wednesday, where we have the bearish bias stance after the bounce of the 50-day moving average at 15460. So going forward, these are the two key levels to watch. So still maintain that short-term intraday bearish bias as long as price action didn't break above the 1560 level. First support to watch for sure will be at the 15460 level. Only a breakdown below 15460 level, which confluences with the upwards of 50-day moving average, will expose much more intraday bearish weakness on the dollar yen to expose the minor swing low of 16th of May next, 15370. only an hourly close back above 15660 will invalidate today's short-term intraday bearish buyers on the dollar yen to see another round of push up. Next near-term resistance to watch 157.450, which is the minor swing high area of 3rd of June, and the all important 158 figure level / 15830. So why this level is important? Because this level induces the BOJ intervention to actually buy yen, sell the dollar, okay, on 2nd of May last month. Okay, so that's for the dollar yen. Aussie dollar continues to actually trade higher, holding above the 20-day moving average, acting as a support. So I don't want to target so tight as the first support at 66.40, where it actually shaped that bounce yesterday. So use slightly lower, no change at yesterday's short-term pivotal support, which is 66.20. So all in all, the short-term momentum still seems to be intact, at least on the intraday basis. Why? Because the hourly RSI continue to shape a series of higher low, right, and hasn't go into its overbought region yet. So all in all, as long as 66.20 short-term pivotal support holds for today, still maintain that short-term intraday bullish buyers within its medium-term symmetrical triangle range configuration that is still in play. Next resistance to watch 67.10, which is the minor swing high of 16th of May and 20th of May. Above it sees the medium-term resistance, range resistance coming in at 67.30 over here. Only an hourly close below 66.20 invalidates today's intraday bullish bias to see it moving down towards the bottom part of the symmetrical triangle range configuration in first step. The next near-term support level to watch will be the minor swing low of 24th of May and 30th of May at 65.90. Below it says 65.60, which is confluencing the minor swing low of 8th of May and the 50-day moving average. So this is what I mean by the ongoing medium-term symmetrical triangle configuration that the Aussie dollar is still involving using the daily chart. So what I could see is that since 13th of October, it's been holding above this ascending trend line support, and since the high of 3rd of February is being, or the upside is being kept below this descending trend line resistance. And this descending trend line resistance, which is the upper boundary of this symmetrical triangle range configuration, is now acting as a resistance at 67.30. All right, so net overall, based on the current short-term technical elements, it seems to us that they are still potentially supporting this ongoing short-term intraday bearish dollar for today in terms of, i.e. dollar weakness. Now, moving on will be the major stock indices. Let us start with the Asia Pacific indices. The Japan 225 once again managed to bounce and survive at the 50-day moving average and the 20-day moving average, which also confluence with our predefined 38,550 short-term pivotal support that we have for the yesterday as well. So still no change, still looking at this 38,550 as my short-term pivotal support. Still maintain that short-term bullish intraday bearish bias on the Nikkei 225, i.e. Japan 225. We in this kind of a range configuration as well. Top of the range intraday basis will be at the 38,975 / 39,070, which is the intraday minor swing high of yesterday, 6th of June. All right, only a break above yesterday's minor swing high 39,070 will expose the next resistance in near term at 39,050 level, which is the minor swing high of 20th of May and 15th of April. Only an hourly close back below 38,550 will see it floating down back to the bottom of the range again, negating today's intraday bullish bias, exposing the next near-term support at 38,290. A break below it sees the key minor range support at 37,750 / 600, which is the low of 2nd of May, 3rd of May, and as well as this V-shaped recovery form on the 30th of May. All right, so that's for the Japan 225. Hang Seng. So Hang Seng going to trade sideways on the intraday basis, still can't break above the 20-day moving average over here. So what I'm going to do now is I will still use that the 18,060 short-term pivotal support level, where so far it managed to bounce off since last Friday. So as long as this level holds, still maintain that short-term bullish bias on this Hong Kong 33 index, i.e. Hang Seng index. So I would have to watch this resistance level here. So this will be my first resistance level, which is this Wednesday minus swing high at 18,730. A break above 18,730 sees potentially 18,980 next. Only an hourly close below 18,060 level invalidates the short-term bullish but intraday bullish bias to kickstart another round of minor corrective decline to expose the next support area at 17,600 level. All right, so that's for the Hong Kong 33 index. German 30 or the German DAX yesterday managed to push up right before the start of the ECB meeting. Then after the ECB meeting came down, it was less dovish than expected. It traded back below the 20-day moving average, but still holding above the key short-term pivotals. No, still holding above this trend line support level over here. So this trend line support in gray, this one in gray, is rather important. Why? Because it's a medium-term trend line that I drew from the low of major trend line, in fact, not medium term, from the low of 18th of January 2023. That means that was almost a year ago, last year. So now back to the hourly chart. So it since managed to still hold above this trend line support here. So with that, right, given the fact that in order for it to maintain this bullish momentum rather than another round of messy sideways movement again, I will tighten the key short-term pivotal support for today to confluence with this major ascending trend line support and also the former minor swing high of 4th of June that managed to break out and see the last rally up. That's currently surpassed intraday to 20-day moving average, which I think I support at 18,500. So using a tightened key short-term pivotal support for today, 18,500, maintain that short-term bullish bias on the intraday basis for the German 30. First resistance to watch for sure, you got to surpass back a bit above the 20-day moving average. Now acting as a near-term resistance at 18,680. A break above it may revisit this minor swing high of 28th of May, which is acting as a near-term resistance at 18,845, which is very close to the all-time high area at 18,925. Only an hourly close below 18,500 will invalidate today's direct bullish bias intraday basis on the German 30 to see it floating down back towards the minor range support level at 18,390/18,350. All right, only a breakdown below 18,350 will start to kickstart another round of minor corrective decline to expose the next near-term support at 18,175. So that's for the German 30. Moving forward will be the Dow Jones Industrial Average, the US Wall Street 30. Still recall that yesterday we do have a bearish bias below 39,130 for it to float down towards this kind of a sideways rangy configuration at 38,550, then followed by maximum 38,280. But the price action didn't materialize and instead tried to push higher and shape higher high. Okay, higher, but it's still holding below the 39,130 short-term pivotal resistance that we highlighted yesterday. But given the latest technical configuration of this price action shaping higher high and also breaking above the 50-day moving average yesterday and break and a retest, and it managed to trade higher during today's Asia session. So with these two latest development in terms earring towards more on the positive side of the story, I'll be rather having a very low conviction to see that potential minor corrective pullback taking place again. So with that, I'll be flipping to a short-term intraday bullish bias on the US Wall Street 30, i.e. the Dow Jones Industrial Average, using this 38,550 as my short-term pivotal support that was being supported on Wednesday. Okay, the V-shape intraday V-shape bounce. So as long as this level hold 38,550, we'll be flipping to a short-term intraday bullish bias. First resistance to watch will be 39,130 for sure, which is also convincing with the 20-day moving average that has been acting as a resistance since the bearish breakdown on Friday at 24th of May. Above this level sees the next near-term resistance coming in at 39,390, which is this minor swing low here, turns into a pullback resistance. And if you do the Fibo retracement from the all-time high all the way down to the 30th of May low, it confluences closely with the golden ratio of 61.8% as well. Okay, only an hourly close below 38,550 will invalidate today's short-term intraday bearish bias to see it floating down to retest the this Tuesday, minor swing low at 38,280. A breakdown below it kickstarts another round of minor corrective decline in extension to expose the next near-term support at 37,890 / 37,750, which is the minor swing low of 25th of April and 2nd of May. Okay, so that's the US Wall Street 30. So very similar as well. A positive element has been seen on the Nasdaq 100 as well. So for the Nasdaq 100, yesterday we also do have that bearish buyers looking for it to pull back down to 18,910, followed by 18,720. But it seems to me that price action is not shaping that desired pullback and instead starts to trade in a very sideways range instead. So with that, first support level to watch 18,910. How do I use this level so tight as my short-term pivotal support for today? I'll use it slightly lower, 18,720. Why? Because it's confluencing also with the rising 20-day moving average. So as long as 18,720 holds on the Nasdaq 100 for today, we'll be flipping to a short-term intraday bullish bias again, given the not so much of a bearish element to support that's much more steeper pullback on the Nasdaq 100 to see the continuation of this bullish impulsive move. Next first resistance to watch 19,160 / 19,230, followed by the top of this ascending channel at 19,400 / 19,425 with confluence with the 0.618 Fibo extension, and as well as the minor Fibo extension of the low of this Monday. Project it over here. It confluence to the 2 times Fibo extension. That means this is something like a extensive wave, minor wave, impulsive minor wave tree on the Nasdaq 100. Only an hourly close below 18,720 will negate this intraday bullish bias to kickstart a much more deeper corrective pullback. Next support level to watch will be 18,460, which is the minor swing low of 4th of June, and as well confluencing closely with the lower limit of this medium-term ascending channel from the low of 19th of April. A breakdown below it exposes the 50-day moving average, which is confluencing with the minor swing low area of 31st of May, both acting as a similar support at 18,230. All right, so that's sum up for the short-term intraday technical outlook on the major stock indices. So all of them are still holding above their respective key short-term pivotal support level. Spot gold. Moving on, let's go to the spot gold short-term technical outlook. So gold XAU / USD. So continue to trade above the 20-day moving average, and it's right now coming very close to the first support that we highlight, 2,382. So I have a range over here, 2,382 / 2,388. Okay, this area here. Okay, 2,388. So still no change. Managed to bounce off from here. So this level of support here is now trade higher high, higher low. So what I do now is I'm going to have a much more tighter key short-term pivotal support right now, using this bounce off, this V-shaped bounce off yesterday. So this will be my tighter key short-term pivotal support at 2,354. Okay, let me copy it. 354. Okay, then this will be my normal support. Okay, so as long as 2,354 short-term pivotal support holds for today, we will still maintain that short-term bullish intraday outlook on XAU / USD. A breakout above 2,388 potentially sees the next near-term resistance coming in at 2,407, which is the minor swing low, former minor swing low of this 17th of May all the way down to 21st of May, acting as a pullback resistance right now. And if you do the Fibo retracement from the all-time high all the way down to the low of 3rd of June, slightly below the 76.4 Fibo retracement. Okay, only an hourly close below 2,354 will negate the short-term intraday bullish bias to see a choppy minor corrective pullback. Next support level to watch will be the rising 50-day moving average, which is the 2,388 support level. A breakdown below it sees the minor swing low area of 3rd of June and 4th of June at 2,320 / 2,307, which is a support range, which is the minor swing low of 8th of May and 9th of May over here. Okay. WTI, West Texas Oil. So still recall that West Texas Oil, we flipped to a bullish bias in the last 2 sessions to look out for that potential corrective bounce. So that potential corrective bounce indeed play out and hit our resistance level at 75.85 over here. So it's now coming very close to this former key support level, range support level that has been tested 1 time, 2 time, 3 time before the OPEC Plus meeting that give rise to that steep intraday sell-off, right, on Monday and Tuesday. So with that, this will be a very key pullback resistance really, and the RSI is now already hit the overbought zone. So right now we'll be flipping back to a short-term intraday bearish bias, since more or less it has worked out this corrective bounce scenario hitting our resistance level. So as long as 76.70 is not surpassed the upside today, we will flip to a short-term intraday bearish bias on West Texas Oil. First support level to watch will be this support zone here on the intraday basis, 74.25/73.90. All right, so this very important support zone, and if you do the Fibo retracement of that entire push up, it also confluence with the 50% and the 61.8 Fibo retracement as well. All right, only an hourly close below 79.70 will invalidate today's short-term intraday bearish outlook on West Texas Oil to see the extension of this recovery to retest the 20-day moving average, now acting as a resistance at 77.85. Above it sees the minor swing high of 31st of May at 78.90. All right, so that's sum up for today's short-term intraday outlook on the broad-based key cross asset. Now, before we go, let's take a look at the calendar. So today's all important data will be focusing on the US job data, which is the official non-farm payroll data, out at 8:30 p.m. Singapore time. So what we could see over here is that now market do expect a slight improvement of 185K increase, 10K additional 10K increase more jobs added from the 175 printed in the month of April. So given the fact that the ADP numbers, that means the privately compiled ADP data, job data, that is something market view as a prelude to the non-farm payroll data, came in below expectation, there's actually a risk that this non-farm payroll data could be slightly lower than what market is expecting consensus, with 185K. So if it came in below 185K, let's say 180K or very similar to 175K in the month of April, that could also imply a rather lukewarm job market, not a red hot job market, US job market. That means that could actually also support at least one interest rate cut by the US Federal Reserve in September, i.e. that could also continue to actually reinforce our short-term bearish intraday outlook on the dollar. That means dollar weakness, indirectly supporting the short-term intraday bullish bias in spot gold, XAU/USD, and with a weaker dollar, lower 10-year US Treasury yield continue to remain soft below that said resistance that we highlighted earlier on at the start of today's daily dose. That could also support that ongoing intraday risk-on behavior that could be seen on the major US stock indices that I highlighted earlier on, based on their respective key short-term pivotal support level. So with that pretty much sum up today's daily dose of market insight. So I wish you a great day ahead. Do have a restful weekend, and we shall speak again on Monday. This is Kelvin here, signing off. Thank you.